All right, we're live here on Cashflow Connects. It is Thursday, June the 24th. We have back again Christine Xu. She is the president and CEO of Moneybroker Canada and Ready Capital Mortgage Investment Trust. Today, she's giving us an update on the real estate market and some of the ways of financing projects. So Christine, welcome back again.
Thank you, Peter. I'm so honored to be here the second time. And little bit intro of about myself. My name is Christine Su. I'm the president and CEO of Moneybroker Canada and Ready Capital Mortgage Investment Trust. I'm been in the mortgage field in Toronto, in Canada, for over 22 years, and I was 3 times the recipient of Canadian Mortgage Award as the Alternative Mortgage Broker of the Year in Canada. So for myself, right now, talking to every client, we just try to provide solutions to your mortgage needs. So lots of times, everybody who call me to say, "Hey, I want to get a mortgage. What's your best rate?" My reaction is, well, we don't have to worry about the best rate. Try to find what's the best situation, what's the best solution for your situation. Like, so you had to tell me what do you really need.
Yeah, no, that's great. And I think that really speaks to, the awards themselves. It's not the awards, it's how you're serving other people, how you're providing solutions to people who may be stuck trying to solve a problem. You're providing a solution to them, and you've done that many times over, and probably obviously got better over time as well as you do that. And so today we're going to talk, maybe you can give us a bit of an update in terms of what's happening. And I'll just go back to what I do during the day. I practice infinite banking, and it's a process called becoming your own banker, but that takes time, takes capitalization, takes compounding, all those pieces. And so, the idea of what I do is not to necessarily, you're not firing the bank. You're still going to need money throughout the course of time, especially if you're in real estate investing or you're buying for personal property, or if you're an entrepreneur. I guess people are always looking for alternative ways in terms of how to and find the most efficient way to solve their problem. Maybe you can just give us a quick update in terms of what you're seeing in the market right now. I assume I've talked to some other people in the business, and they say June is a pretty busy time for you. Is it? Can you concur to that?
Yeah, we are very busy, and June, like this June especially, because the market is so hot, the real estate value increased quite a bit. So for us as an alternative mortgage broker, we're specialized. That's what we specialize on, and we see more and more people using we call it a B lender or private lender as a solution. So briefly, I want to say right now, when we're talking to clients, we always try to see whether the client is we call this A client, a B client, or private client. So A client is if you walk into the bank say, "Hey, you are approved." That's A client because you have a good income and good credit. Lots of times when we're dealing with entrepreneurs and investors, they may not necessarily easily being approved by the bank because their income, being a self-employed person, you probably have a very good accountant, and you may not showing as much personal income as the whole picture. Your company probably doing well and making lots of money, and you may not even qualify from the bank because your personal income, net income, is not that much. So we call those clients B clients. B clients not like anything like a less better. We just say we probably can get you a mortgage from Schedule B lenders, and then sometimes some clients do not have income at all. Like some people they are high net worth individuals, and they may not even qualify as a Schedule B lenders because Schedule B lender, you still need some income. However, being an investor, there's always other solutions. Right now, I want to talk more about what we call the private private investment, private mortgages. You're not qualified for Schedule A, you're not qualified for Schedule B, but there's so many Schedule C lender or private lenders out there probably can help you. And right now, because the COVID situation, and surprisingly, there's so much money available. Individually, we see the lowest debt ratio right now as an individual credit card uses, and we have the lowest debts in the history. And also for the institutionalized, there's so many money available. So lots of people thinking about real estate is the best way to put the money. So as a lenders, for private lender, we can see historical low interest rate. A month ago, I think I did a Zoom meeting with Peter, and at that time, the lowest private mortgage rate is 5.95. Today, the lowest interest rate is 3.99. And just started, there's a new kid in the block in the Canadian mortgage field. There's a lender starting interest rate is 3.49. So 3.49, I want to talk about a little bit more about this mortgage. It's revolutionary. From a mortgage professional as myself, this is the first time I've seen in the Canadian mortgage field. There's a new product coming out. It is very exciting. I think especially, Peter, for your group, I'm talking about cash flow. This lender, you don't have to pay interest. You don't have to pay principal until you sell your home or refinance. So free up 100% of your cash flow in your equity.
Sounds pretty good. Is this something similar to like where we'd see people who are maybe 70, 80 plus would deal with like a reverse mortgage? Is it similar to that? Is that qualified to younger people now? Is that kind of?
Yeah. So it's similar to the way reverse mortgage mostly to seniors. The youngest qualified age is 55 years old. For reverse mortgage, you do not have to pay principal and interest until you sell your home. So this is a new product coming into the market. We call it appreciation mortgage. And you don't have to pay interest. You don't have to pay principal. You don't have to qualify with your age. The only thing they qualify for the borrower is credit score. The minimum credit score has to be 640. And they give you 40% of your equity value. So for instance, you already own a home, say $1 million home, or your parents already own a home, you pay for so long, you completely paid off. The value today is $1 million. You can borrow up to 40%, $400,000 out. So that $400,000 out, you don't have to pay interest. You don't have to pay principal until you sell your home or refinance for another lender. The catch is very different from this mortgage. Well, as I mentioned earlier, the interest rate is only 3.49. So there's a little bit catch. So this mortgage, they call themselves appreciation mortgage. They want to be as an investor, they want to take advantage of the market appreciation. So the interest rate is not fixed. It starts with 3.49, and maximum interest rate they will charge you is 7.99. The only way they will charge you higher interest rate than 3.49 is you make money. For instance, you purchase $1 million home, and 1 year later you sell it, so you make 10%. 1 year later you sell it for 1.1 million. You make 10%. So this appreciation mortgage will charge you up to their maximum 7.99. So you make 10%, they will charge you 7.99 of the interest of the total principal. So if you borrow up to 400,000, that's 40%. That 400,000, the interest is 7.99. However, the same property, if you purchase today for $1 million, you sell it for 5 years. You sell it 5 years later, you're still making 1.1. So the average return on your investment is only 2% because 10% for 5 years, right? Only 2%. So this fashion mortgage, we call fashion appreciation mortgage. That's the real name of the mortgage. They will charge you minimum 3.49%. So I think that's really fair. If you make money, they will charge you a little bit higher interest up to the percentage of the market appreciation. If you don't make money, they will charge you minimum 3.49. And the good thing for this is for people who you don't need to qualify. Lots of people who do not qualify because you don't have income or you don't have good enough credit. Well, they need a credit for 640, sorry. But if you don't have income, you can qualify for your mortgage, right? And sometimes for investors who want cash flow, you can purchase so many property until you can keep the cash flow, right? For this product, the investors for real estate product, real estate in the real estate field, you don't have to worry about your biggest concern of cash flow. You have a rental property, you keep all the rent. All you need to pay, of course, the property tax and other maintenance fee to maintain the property. But you don't have to pay your principal and interest until you sell or refinance. And it is also a completely open mortgage. So sometimes people, because between houses, they buy a new property, they cannot sell their old property, they don't have enough down payment. So we can refinance the old property and taking 40%. And when you sell your property, you can pay it off. There's no penalty on it.
So I guess in lieu of the penalty, they're saying we'll charge the rate. They'll change the rate depending on how much you appreciate. So you need to have at least 60% equity in the property. They'll provide you 40%. Sorry, can you clarify the refinancing, how that works? Will they also, how does that work with the refinance part of it?
Yeah. So first of all, let me just clarify. So they will only finance 40%, but we have other source to top up to 65%. So if you have 35% down payment, we can help you to get this mortgage. So for purchase and refi, they will treat it the same. So you can use this product to buy a home. When the closing time, if you have 35%, we top up to 65%. We can do the purchase. We do the refi as well. So how do you see their value? I mean, how much they charge you later? So when you purchase home, of course they use the purchase value or appraised value, whichever is higher actually to lend it to you. So most banker when they do your mortgage is purchase price or appraised value, whichever is lower. So sorry, I correct myself. Sorry, they use the appraised value. They use the current value. I'm just thinking sometimes.
Yeah, it doesn't matter what you buy it at. It's what they appraise it at.
Right. So sorry, I correct myself. I'm thinking this scenario when people purchase a condo 5 years ago, pre-construction. Yeah. Right now the value going up, so they use the current value. So that's for the purchase. Refi is the same thing. The house value you purchased many years ago and already pay off or have a very minimal mortgage there. So they are appraised with whatever value is the current value. So maximum they lend you 40%. So how do you pay them off? If you sell your home or refinance. So if you sell your home, of course, that's the market value. So they will decide how many years you have sold your home, what's the average annual increase. If your annual increase is less than 3.49, they will charge you 3.49. If your average annual increase more than 7.99, they will charge you up to 7.99. But anywhere in between, if your annual increase is 5%, they will charge you 5%. So this product, I think there's so many use for this product. for instance, right now there's so many people in Toronto, they want to build a laneway house, for instance. They need to take some equity out from your house. So yeah, you can use that to take out the equity for your laneway house. And sometimes you need to renovate your home. You want to say people want to sell your home, but the house is so run down, they want to renovate it and sell in a better price. And this fraction mortgage, actually, I think is very fair. So again, we use an easy number. The house today's value is $1 million and probably rent down, but they can give you 400,000. So you spend the 400,000 to renovate your home. 8 months later, the house is already completely renovated, and you sell your home for $2 million, for instance. So your profit is a $1 million during 1 year. However, they will see you spend 400,000 to make it $2 million. So they don't think that's fair to charge you the total appreciation from 1 million to 2 million. So they will use an appraiser at that time to say, if your house didn't get renovated, and what's today's value? So the 1 million house next year, the appraiser said, well, this house based on last year's report for 1 million, if the market remain the same, maybe market increase 2% or 3%, they only charge you 2% or 3%. They do not charge you the money you put it in.
Right. So you do have to make, I would suggest maybe people document the before and after so that aligns, so that
Yeah.
they're to ensure that they're valued at the right. I was going to ask you another question. So to get the appraisal, I assume that they would have their own appraisal process or people that they would work with that would be accepted
Yeah.
to provide that.
We all use a third-party independent appraisals, but not every appraisal is approved by a private lender or this company. So usually in each cities they have a very small group of appraisals. They are really strict and like they don't increase or decrease value by the request, right? So they all are very strict appraisals. So right now, this product only available in Toronto, GTA, and Vancouver, the Vancouver, the urban area. So for those two cities, if anyone need to know more about this mortgage, want to get this mortgage, they can contact me.
Right. So it literally it's just I've heard of lenders, that focus on maybe, cities that are above, say, 50,000, 100,000. You're saying just for Toronto and Vancouver, this is
Yeah, right
available?
now the product so brand new, just started.
Yeah.
So they want to start with those two major urban city, close to urban centers, the
Right.
properties. So each properties they will do like like Toronto and Vancouver. Obviously, there's some expensive properties. So each properties they will go up to 1.5 million only. So if your property worth 6 million, for instance, they will give you only 1.5 million. And each applicant, you can have many other rental properties. Each applicant will only be approved for $2 million. So one household
Sorry,
can.
can you repeat that again? Those clip levels in terms of amount that you can get?
Yeah. So each property's maximum is 1.5 million,
Okay.
and each applicant, the maximum is $2 million, and the one applicant's name.
Now, say the property is valued more than, maybe this is where that bridge loan comes in between, right? If
Yeah,
they'll appraise up to that value, and then you have that second lender to come in to bridge that
to up
gap.
to
Is that
65%. That's right.
right? Okay. How does that process work? And is that open? Do you have a number of other lenders? Is it more private lenders? Does it sit as a second position? So it's at a, what kind
Yeah.
of,
So the gap is a private lender. So we will do a private lending. We're based on 7.99 as a second mortgage,
Mhm.
but then that's just a regular second mortgage. You do need to pay the interest. You don't need to pay the principal until you sell, but you do need to pay the interest, and it's renewed every year.
And and there would be a lender and brokerage fee on top of that as well.
Right. Yeah. So for the appreciation, fashion appreciation mortgage, the lender fee and broker fee in total is only 2.5%. It's a fully open, so you can use as a short-term solutions. You can keep it forever until you sell your home. And for the if we top up as a second position, our interest rate is 7.99 as a second mortgage, and there's a broker fee, a lender fee on that. We will depends on the location of the property, type of property. We go up to 65%, but may not be necessary 55%, 65%.
Right. Okay. Well, that's good. And yeah, I think that definitely makes sense that they don't even with this product up to 40% because they're hedging their bet against just making sure that they've got coverage that the
Yeah.
not owed is not more than the value of the house, obviously.
The reason we actually provide a second mortgage is for the purchase situation. So right now, like for myself, I have so many the purchaser. They are because of COVID situation, they actually overseas. Like they have 35% down payment, even though they overseas. The traditional lender they will not close their mortgage because they are not even here. So we top up to 65%. We get a mortgage closed. And if they're coming back here, if they want to move the mortgage to a traditional Schedule A lender, they can do that. It's fully open anyway.
Right. Okay. Well, this is really good. Great information. Christine, I really appreciate you in how you really look to help solve problems for your clients and create solutions for them. I think as people get into whether or not one is an entrepreneur just buying for primary residence, but even as an investor looking to buy other properties, get their hands on it, don't feel, I think a lot of people feel that they're stuck from a financing standpoint, but there are so many alternative options out there. And I think that speaks to your success in the industry as well. So, thank you for adding that. Is there anything else you want to add? And also, lastly, can you tell people how they can get in touch with you?
Yeah. So I want to add a little bit more. So the
Mhm.
mortgage we try to talk about today is called the fashion appreciation mortgage, but that's a brand new product. We are actually providing so many different mortgage products for the borrower. The traditional private mortgage, mainly they are interest only mortgage, really free up your cash flow. So I want to actually mention a little bit. So like today, the like a Schedule A lender, for instance, the interest rate, I just randomly pick a number just before the seminar. If your interest rate is 1.75 and 25 years amortization, your monthly payment for $100,000 is $411. And if you go for a Schedule B lender because you're self-employed and something like that, couldn't qualify for a Schedule A lender. Pick a interest rate today. Schedule B lenders interest rate is around like less than 3% for a lot of good credit purchase deals. So I choose number 2.75 as 2.7 for instance. $100,000 for 30 years amortization, monthly payment is $407, even cheaper than the Schedule A lender in terms of the monthly payment. One is 30 years amortization, one is 25 years amortization. But for private lenders, so like last month, I'm talking about the cheapest private mortgage rate last month was 5.95, and private lending usually is interest only payment. So for $100,000 for 5.95, the monthly payment is only $496. So really, for using a private lending is it's not bad at all because you really freed up your cash flow if you're not qualified because of income, your credit, and other situation. That's a very good solution for you. Plus, we're talking about this no interest, no principal payment. You 100% you got to keep your cash flow for the rental income, for instance. I think that's incredible solution. That's why I'm so excited about this new product, new kids in the in the block for Canadian mortgage field. So yeah, to get in touch with me, again, my name is Christine Su, last name spelled XU. If you Google my name, Christine XU, Moneybroker or mortgage broker, you'll see me in Google first page. Yeah, Christine Su Mortgages. Or my website, moneybroker.ca.
Awesome. Christine, thank you again. And, not just right. I think you've finished that off nicely. Just to kind of summarize, we talked about something new, but there's so many different ways to look at these things beyond just the rate. And again, your success in the field has really proven how you're serving others. So thank you again for sharing today.
Thank you, Peter.